Okay, so for the first video of this channel, I figured it might be an interesting idea to look at Veolia Environment, the waste management behemoth here in Europe. They operate waste management landfills, recycling centers, water treatment plants in France, in Italy, in Ireland, in the UK, and even in the United States. Um, they're listed on the Euronext of Paris, and Veolia is actually quite an interesting stock because quite recently they announced a merger with one of their biggest competitors here in Europe, namely Suez. Now, this is concerning a 15 billion euro merger, so it's a very, very big one. And they decided to merge to make sure that they can be competitive with the approaching threats coming from the east, namely China, which is the argument that they mentioned in their statement. Um, so this is a 15 billion euros merger. But part of this deal by the European Trade Commission was actually also that Suez spin off about 7 billion of their assets into a separate entity, into a separate company to make sure that Veolia does not have a complete monopoly over the waste industry. Um, So yeah, that being said, what I wanted to do is just look at the financials of Veolia prior to this merger, because of course after this merger, many things are going to change. Their revenue is going to grow, their EBITDA is going to grow, their debt is going to grow. But if I would be projecting on that, I'd just be speculating. So um, because they're going to be operating under the Veolia umbrella together, I figured it might be an interesting idea to actually look what Veolia itself has been up to for the last 10 years. So I accumulated all the data here, and every now and again there's some few missing data points, like for EBITDA here for 2013 and 2012. But that is because the annual reports didn't actually report EBITDA yet back in those days. But for the most part, I tried to fill in everything I could. So if we're going to have a look here at 2012, the revenue of Veolia Environment was about 23 billion, and towards the end of 2021, it was 28.5 billion. Now, in all fairness, most of the revenue growth here was because of this final year here in 2021, which is well beyond any of its previous years, and this is mostly because of the COVID stimulus year. Okay, most of the companies in 2021 actually recorded record profits because of the injected money into the economy. So this year might be a little bit of a fluke compared to all the other ones. So just take this little number there with a grain of salt, or like this entire year actually. But that being said, still, their revenue growth over this 10-year period is about 2.4% compounding annual growth rate. Now, that's actually a pretty good growth rate for the business that Veolia is in because, um, I mean, you can't really compare it to like a Tesla that's growing like 50% year over year because it's an entirely different business. Veolia is in the waste management. They have contracts with municipalities and with governments, and they have a steady income flow. They're not growing that much, but it will always be there. As long as there's going to be people who are going to be making trash, Veolia is going to be in the business of cleaning that trash up. So 2.4% revenue growth over 10 years, sorry, compounding over 10 years is kind of what we expect for a waste management company. Then we will move over to the next column here, which is EBITDA, which stands for earnings before any accounting gimmicks, so before interest or depreciation or taxes or amortization. So any accounting gimmicks are excluded for this particular number because I don't really care about that. Okay, like the moment that a company, like for example Veolia, has to invest in buying like 1,000 waste trucks, it's going to be shown on the financial statement because it's going to be an investment that they're going to have to make sure that they can operate properly, which is fair enough. But I'm just interested to see whether or not their bottom line, or sorry, the top line is growing, which it is, and compared to that, how much of that top line revenue is being converted to their bottom line, how much of that revenue is actually being turned into earnings before any accounting gimmicks. I just want to know if their profits are increasing. Okay, that's why I'm chosen EBITDA for this particular column. Now, as we can see here in 2014, it's about 2.7 billion in EBITDA, which is rising all the way to 4.2 billion in 2021. Now, again, bit of a COVID stimulus thing, but by and large, the entire trend that we can see over here is that it's growing quite well. In fact, it's been growing annually by 7%. Um, for a waste company, this is actually really, really good. And what this shows us is that even though revenue is not growing as much, their earnings are growing a lot faster, which means that their profit margins are increasing, which means that they are more efficient in the business that they operate, which means they are able to create a bigger profit with the revenue that's being given to them, which is very much what we like to see. They are becoming more efficient with their business. So for the next column here, we have debt, short-term as well as long-term debt. And what we see here in the start of 2012, they had quite some debt to actually, when they were starting to get the business off the ground still. For the years after that, it's actually remained quite stable around the 8 billion mark, and only recently it's been going up. In 2021, it's been to a record high of 13 billion euros in debt. But if you move on to the next column, you might notice that all the 4 or 5-ish billion that they borrowed over the year 2021 is actually still in their bank account. Okay, and this is coming back to the merger that they have planned with Suez, because it's going to be a 15 billion euros merger, right? So they're going to need to get the cash to order in order to actually proceed with that merger. So that's what you see. The borrowed money here is still in their bank account to prepare for the merger in 2021 anyway. And because Veolia is such a massive corporation, I think they employ about 200,000 people at this point. Some excess cash to make sure that they can cover their expenses is always very much a good thing. Market cap is basically the value that the market is pricing Veolia Environment as. It's the outstanding shares times the share price. So it's mostly based on speculation, really. So we quickly go move on to the next column, which is enterprise value, because I think enterprise value is a lot more interesting than market cap can ever be for a long-term investor, anyway. Because what enterprise value is, it's the market cap to which you add the debt and subtract the excess cash. Okay, is the entire value of the business as a whole. Let's say, for example, that a massive company like Apple is for some reason going into the waste management business and they want to buy Veolia Environment. If they want to buy it, not only do they have to buy the shares off the market, right? They also have to make sure that the debt that Veolia has is being covered. So it's part of the company. You can't separate the two, okay? The debt is part of the company, and that's why it's included in the enterprise value, the full value of the company. Now, it started off as like a 17.5 billion enterprise value in 2012, which has increased to about 28 billion in 2021. Now, important to note again here is that most of the value increase is because of the recent year here, where it got some market appreciation. Their stock price has been increasing. The next column is EV/EBITDA, which stands for enterprise value, which is this column, divided by their earnings, their EBITDA. So basically what this means is how many years does it take with their current earnings to pay down the entirety of their company, right? And we can see that historically it's been about 5.3 times on average. Veolia needs to operate about 5 years before they can buy back the entirety of their own company. When it comes to waste management, though, I think it's important to note that this is quite low compared to its United States counterpart. Over there, you have the two biggest companies, which are Waste Management as well as Republic Services, which are always circling around the 14 times EV/EBITDA ratio. Now, of course, it's important to note that the US market is a lot more saturated than the European market is. It attracts a lot more investors and is considered a bit more of a safe place when it comes to investing because of the capitalistic structure. But nevertheless, this is quite low compared to their peers, so there might actually be some increase in market multiples to be expected there, but we'll get back to that at a later point. The next column here is net debt. Now, as an investor, you always want to look at the debt that a company has and see whether or not they're actually able to finance that debt. Because if a company is going bankrupt, the first people who are going to get paid are their creditors. Any supplies that they still have outstanding that they have to pay for, any loans to banks that they have to pay their employees. And at the very bottom of the list, the very last people who are going to get compensated with the leftover money that is still in their vault is going to be the stockholders. It's going to be you and me. Okay, so the moment that a public traded company goes bankrupt, you're the one who's holding the bag as an investor. So you want to make sure that you're investing in a company who has a very low likelihood of becoming bankrupt. So what we're mainly looking for is a net debt to EBITDA ratio of about 3 times or below. And that's not just any random number. That's also the same number that the big banks use when it comes to evaluating the finances of a company. Because the moment that a company is too much in debt compared to their earnings, so more than 3 times, it becomes a more risky investment for a bank to actually loan them money, right? So if they do loan the money beyond that 3 times multiple, they start charging a bit more interest because their investment is not as safe, because the chance of them paying it back reduces with the more debt they have. Okay, and a safe number for big banks is always considered around 3 times, which is very much Veolia has very much been bordering that number for the last 10 years. Now in 2021, it's slightly beyond that point, but we're actually okay with that because they're using the money to merge with Suez, which will increase their revenue and EBITDA presumably in the following year. So I'm assuming this one will come down ever so slightly. Now for the next statement here, we're going to look at the cash flow statement, which is this table here. The first column is CFO, which stands for cash flow from operations. Now, basically what this means is this is the entire money that the businesses operate. This is the money that Veolia acquired by running their recycling centers, by running their landfills, by running their water treatment plants. This is the money they get from that business. Okay, which has been growing steadily by about 5% compounding annual growth rate, 5% year over year. Their cash flow from operations has been growing, which is very much what we like to see. Okay. The next column here is CapEx, which stands for capital expenditure. Now, this basically implies anything and everything that is required to make sure that the business can operate in its usual manner. So this is financing new trucks, new garbage trucks. This is financing new recycling facilities. This is making sure that all the machinery is up to date, all the machinery is getting replaced if it's broken. This is insurance. This is anything you need to keep the business running the way it is. This is actually incorrect, so I'm just going to cut that out here. Now the next column is the free cash flow. Now as an investor, you want to be very interested in this particular number because this is basically your pro rata ownership of the company. Okay, this is the money that they make after everything else is expended, after their investment, after making sure that the facilities are running properly, after paying management, after paying insurance, after paying everything. This is the money that's still left in their vault, and this is your pro rata ownership of the company. This is going to flow directly towards the shareholders, and in the form of dividends or share buybacks, or they can choose to invest it to increase revenue growth in the future. And this free cash flow has also been increasing quite steadily here over the last few years. Now, to be fair, it's fluctuating a little bit time by time, but it's because they're making investments along the way as well. So it's going to be fluctuating nevertheless. Overall, the growth rate is 47%, which is absolutely astounding, but mostly influenced again by this last COVID number. Now, if this was actually a bit more closer to that one, you can see it actually comes down by a lot there. It's really coming down by a lot, but just take that one with a grain of salt. The next column is the outstanding shares. Now what you can see here is that it's mostly remained flat over the last 10 years. It's been increasing a bit, it's been decreasing. They've been buying back shares here in 2018. They've been diluting it a bit again in 2019. They bought it back a year later, and 2021 they actually diluted it by quite a bit. But this is because this is also a way for them to actually raise money for their merger of 15 billion. So I'm actually okay with that because this money is going to expand the business and expand the future revenue and earnings growth. The next column is the free cash flow per share, in which you can see that also the free cash flow per share has been increasing steadily over the last 10 years. This is the price, the stock market price, the way you would find it on the exchange, how much you can buy it for. And this is the free cash flow yield. This is basically the amount of free cash flow per share that's being paid out to investors, which is circling around 6% historically. Okay, so these were basically all the numbers and all the financials. So now that we know this, I want to make a forecast. I want to make an estimate to see where exactly this company is going to be heading 10 years from now. Now, again, I would like to note again that they have initiated a massive merger. So any of the revenue or EBITDA numbers are going to be vastly different next year, a lot higher probably than they are in this particular model. But I don't have the data for that, so I can't really use it and I can't make a forecast when it comes to that. So I'm just going to make the forecast with the data I have available to see whether or not their investment is, or whether or not Veolia is a good investment prior to the merger. So let's see, the EBITDA has grown about 7% annually. Now, to be fair, a lot of that has to do with the recent COVID blip. So I'm actually going to say that for the next year, because there are some economic headwinds coming our way with recessions and inflation and many bad things, really, I'm going to say, you know what, I don't really expect your earnings to grow that much over the next year. I'm just going to say it stays flat, okay? I want to be conservative. When I make an investment, I want to make sure I have the most conservative estimate. And if that conservative estimate beats the market, I'm going to be interested, okay? So I'm going to be conservative with the earnings growth. I'm going to say for the next year, it's going to stay flat. And after that, it's going to grow by 5%. Now, annually, historically, it's been growing by 7%. I don't think it's going to keep doing that. I'm going to say it's going to be growing at 5%. And to be fair, even that might be a bit on the high end of the actual growth. But historically, it's probably an accurate assessment. Now we get to the market multiple. Okay, like I mentioned, its US counterparts have a market multiple of about 14 times. I don't expect Veolia Environment to get anywhere close to that number. Actually, historically, it's been at 5, which is relatively low. You can see at the recent year, it's moved up to 6.6, which I think is more to its actual accurate number. I'm going to be conservative. I'm going to say it stays at about a 6 times multiple. Oh, sorry, 7 times multiple. Even though across the sea, it's going to be double that. It's going to be a market multiple expansion. If there is, it's only going to be in our, only going to be beneficial for us, right? Because like the moment that it changes to 8 times, you can already see that the stock price projection is going to increase drastically. But I'm going to be conservative because I don't know what's going to happen. I think it's going to stay around the same, probably increase a little bit. So I'm just going to give it that leniency and say the market multiple expansion is going towards 7 times, which gives me an enterprise value of about 46 billion, less the debt and the cash, makes me with a market cap of about 43, divided by the amount of shares outstanding, gives me a stock price in 10 years of about 70 euros. For the next model, we have the free cash flow model. Now, again, free cash flow has been increased to 2.17 in 2021. Now, again, this was a COVID blip. I actually don't expect them to increase from that number too much. So I'm going to say for the next year, it's going to be flat. It's not going to move up. It's not going to do anything. Okay, I'm just going to say it's going to stay flat because the big cash injection is going to completely skew the numbers, and I just want to be conservative with my estimates, right? But afterwards, I do think it's going to grow, and I think it's going to grow at around 7%. Now, historically, it's been growing by a lot more than that, but let's see if we just normalize this to a normal number, not a COVID inflated one. It says about 9% average. I'm going to be conservative and I'm going to say it's about 7% because I don't know what's going to happen. And in case anything bad happens in the future to the economy, I want to make sure that I prepared with a conservative estimate. So I'm going to say 7%. I'm going to say the free cash flow yield is going to stay around 6%, which is what it's been doing historically. And that gives me a stock price 10 years from now of about 62 euros. Currently, you can buy as many of the stock as you can for 26 euros and 10 cents. Now the free cash flow method says it's going to be around 70. The enterprise value expansion multiple is going to say it's going to be around 62 euros 10 years from now. I'm not sure which one is right. I'm just going to say the truth lies somewhere in the middle. So I'm going to say it's going to be about 65 euros and 82 cents, which gives me about a 15% compounding annual growth rate for the next 10 years. Now, the US stock market on average returns about 10% annually. So actually this number, Veolia Environment, is beating the stock market with relatively conservative estimates when it comes to their earnings growth. And therefore, I think Veolia Environment is actually a pretty good investment, at least prior to the merger. But I think also definitely after the merger, because their earnings and revenue are only going to be increasing. Because it's returning 15%. And it's not a risky stock. Like if the economy turns bad, then you see with companies like Tesla or Louis Vuitton or Gucci bags, that the moment people have less money to spend, they're not going to spend as much on luxury cars, on luxury bags, on any of that things. So I think stocks like Gucci bags are going to go down quite a lot. Their revenue is going to go down, their earnings are going to go down. But for Veolia Environment, which is a waste management company, no matter what the economy is doing, waste is going to be there, okay? And actually, just last week, they actually renewed many of their contracts with municipalities and with governments. So their cash flow is relatively secured. There's not, it's locked in for the next few years. So I think in summation, when it comes to Veolia Environment, I'm going to say Veolia Environment is a very good stock to have in your portfolio. It's a conservative stock. It's going to beat the stock market. Now, it's not going to 10 times your money in the next 5 years. It's really not, because there's no way for it to grow that much. It's quite limited by the business that it's in. But nevertheless, it's a safe stock which gives good returns. Okay, so thank you so much for watching this video. I very much wanted to make videos like this concerning European stocks, because when I was looking on YouTube for some stock information for tickers I was interested in, I was never able to find anything concrete and anything useful for me to base my opinions on. Now, at the moment that I'm looking for Tesla or Apple or PepsiCo or Coca-Cola, there are many, many, many videos out there when I put in that search query that will help me make up my mind. But for many European stocks, it's not as popular on YouTube. So I wanted to make sure that European investors have the best information possible to decide whether or not they want to invest in a company. So yeah, with that being said, thank you so much for watching. Press the like button and all that good stuff, and I'll see you in the next video.